Hello, you're watching Money 9. I am Krishnakumar, and today we are going to be telling you all about the dozens of NFOs and IPOs that have hit the market, and those that have gotten you thinking as to whether you should go ahead and invest in them or not. What are the do's and don'ts of investing in these new and untested NFOs and IPOs? And most importantly, how do you build a portfolio with the right combination of stocks as well as funds? That's going to be the topic of this Money Masterclass. And joining us is Lakshmi Iyer of Kotak Asset Management Company. Lakshmi, thank you so much for being with us on this Money Masterclass. Thank you so much for being with us. Pleasure having you. I want to begin by asking a very simple question. Right now, we're in the thick of things where so many new fund offers, NFOs and IPOs in the market. All talk is about IPOs and NFOs for depending upon people's interest when it comes to investing. Tell us at this stage, how should investors approach these NFOs and IPOs that come with big claims along with them?
Sure. So firstly, I would say that, in fruit or in food analogy, one is apple, one is custard apple. Both are fruits, both are edible, both are good for health. Nutrition varies, obviously. It is very important for you to have your basic health check, and when I say health check, I'm talking about financial health check, and your basic risk appetite before you decide whether you want to do either or both. IPO or initial public offer is essentially a part or an opportunity for an investor to participate in the growth story of an individual company. So these are shares being floated, and therefore you get an opportunity to be part of that. So it's an individual, it's a particular company belonging to a particular sector, having a particular business. Whereas if you look at NFOs or new fund offers, these are schemes which are offered by mutual funds with an existing track record. These are new fund offers predominantly you see these days in the open-ended space, which have differentiated offering. Either it could be a multi-cap or a flexi-cap or a global strategy or a thematic flavor. So depending on what your risk appetite is, depending on what suits your palate, that should be the deciding factor whether you should do all of it, some of it, or none of it.
So if I were to ask you simply, where should an average investor start from? Somebody in their 20s who are starting out to invest, in this market at this point in time, how should they go about investing? Especially if you're saying the NFOs are a safer, better route to start out with. How do you choose from this current, a flurry of NFOs that have hit the market?
First and foremost, before you embark on your investment journey, whether it's the start of your investment or the mid, is to assess your risk appetite. And we say this to everyone, every investor, irrespective of the age at which he or she is starting, know your risk appetite. Having a certain your risk appetite, you can do it yourself. There are DIY or do it yourself options, or most of them prefer obviously engaging the advisor, of an advisor or a mutual fund distributor, as the case may be. Once you engage with them and they actually try to assess this for you, if the conclusion is that, I can take reasonably good appetite of risk at this point in time, because you have a steady stream of income and you don't have any immediate mass or huge capital expenditure apart from your recurring expenditure, then the portfolio can actually tilt slightly more towards equities. And that number can vary, again from 60% to 70-80%. But if the converse is true for you, you're starting off young, but you say, next 2 to 3 years, I want to invest in a house and I'm saving money for that. Then the equation actually tilts, and then you are slightly, subservient on equity and higher on fixed income. So that's the first starting point. And then once you have ascertained that, equities is the asset class for you, then you sit and thrash out. There are so many open-ended, good track record performing schemes over and above what the NFOs have to offer. And once you've seen that, my portfolio has it all, there is this NFO in the market by a particular fund house which I don't own. I don't have global exposure, for example, in my equities portfolio, then NFO which offers a global opportunity could be your best bet. Likewise, if you say that, oh, I do not have, say, this particular theme in my portfolio, then a thematic offering via NFO could be your best bet. So as I said, it's about trying to draw those contours, and once you've drawn those contours, then you start filling in life into your portfolio.
Right. Talking about portfolio, the best portfolio, they say, is a combination of stocks and mutual funds when it comes to an aggressive investment portfolio that is willing to take on some amount of risk, but at the same time, hoping for it to pay off eventually. So, talk to us about building this ideal portfolio that is a combination of stocks and mutual funds. How does one go about doing that?
This is like, hunting for your ideal partner, Krishna, which we all know may not be really very ideal. But I think the next best thing you can do is, as I said, and I will focus, as cliche as it might sound, focus on your ability to fathom risk. In this case, you said that, okay, the investor is okay to take on risk. Yes, you can have a healthy blend of mutual fund schemes as well as IPOs or stocks. It could be existing stocks which are already listed. And if you believe that you have the wherewithal and you have done your research and homework, and you believe that this is your next multi-bagger, it can be a reasonably good chunk of your portfolio. While there is no real rule of the thumb to really define how much of stock I should own, how much of mutual fund schemes I should own, there is no real global or domestic definition for that. I think it needless it would suffice if I would say that if you have a reasonable, I would say a good 50-60% plus of your equity allocation via mutual fund, and the remainder in a quality cherry pick portfolio, which is either advised or you have the own bandwidth to do that, that's good enough for a risk taking individual.
All right. So what if that person isn't a risk-taking individual, which is actually a better question to ask, Lakshmi, because at this point in time with so many job losses, such pay cuts, and such uncertainties regarding paychecks, clearly there is a need to sort of balance out your portfolio and make sure that it errs on the side of caution than otherwise. In this kind of an atmosphere, what do you think is the best way of going about investing money, be it into an NFO or an IPO, an existing mutual fund or existing stocks?
Fair enough, given that where we are as far as the markets are concerned, we've seen a good run up. People call it the dream run. We've seen aspirations rising, wealth effect growing. But at the same time, obviously, we have seen COVID impacted casualties on lives apart from livelihood. So it's important to maintain a balance at every point in time. And I think that is where strategies are available within the mutual fund umbrella to suit the risk appetite, which can pan through multiple cycles. One such category which I think investors could definitely look at owning is a category called balanced advantage category. Now, this category actually oscillates in the allocation of debt and equity, not based on moods, but based on the momentum of the market and various other quantitative and qualitative parameters. So this can be a good a core allocation to an investor's portfolio, even if she were or he were to be a first-time investor. You could be a DIY investor, or you could be an absolute conservative investor who is very mindful that bulk of your investments are actually locked into traditional mode of investments. So for all those categories, apart from having a bunch of diversified equity holdings, which is very good to iron out the risk, a balanced advantage fund category could be a welcome addition.
All right, we're still on the topic of funds. I just want to understand what is your take on buying gold funds in this market at this point in time?
given where we are on interest rates, we are at almost rock bottom as far as the global interest rates as well as domestic interest rates are concerned. Slowly and steadily, inflation is creeping back into households, whether it's in India or world over. And this, I would say, scenario is a very good potent breeding ground for a commodity like gold to do well. So therefore, the medium to long-term outlook on gold remains to be positive. The way to own is obviously paper gold to our mind. So you could own gold funds, gold ETFs. These obviate the need to really own physical gold, and you can have the comfort of owning this asset class without really physically owning the gold. Be mindful of the fact that gold has to be like a term cover to your financial portfolio. So use it sparingly, maybe 5-15% of your allocation to gold. Don't try to get carried away again by the returns if they were to rally and have an overwhelming proportion of gold in the portfolio.
All right. So clearly, balance is the name of the game at this point in time. Another question here. You are talking about a time also when people could be having a certain amount of money stored up in their savings bank account, looking to invest that chunk of money into mutual funds. What is the best way of going about that? Is it better to do it in the SIP route as usual, or is it better to identify certain, as you said, balanced advantage funds and park your chunk of money that is saved up in that?
The answer to that would be what is that intended money, that kitty that you've kept in a bank account in savings or fixed deposit? Is it meant to be for fixed income, for meeting exigency purposes? Then none of the equity options will really work. That money has to be kept in relatively low duration fixed income strategies. But yes, if that money is trying to find an avenue into a wealth generating or a potential wealth generating asset class like equity, then clearly if it were to be lump sum investments, it can be considered in balance advantage kind of category. But if one were to stagger it, then SIP is a better portfolio.
All right, but so far you haven't said too much about IPOs. Are you being a little wary of all the exuberance and the enthusiasm around IPOs at this point in time?
It's not about exuberance or being wary. I would not call it that way, Krishna. I think what is very important is that every company has its own unique characteristics. It's a leader or maybe a part of its entire business. So as I said, do your homework, do your research, be completely on top of it, because ultimately if you get swayed by the wind, then wind will be the only thing that is left. So be mindful when you are investing. Not all IPOs are bad, but obviously the reverse is also.
And would you say that the way that this glut of IPOs that have hit the market, do you think there are many of them are overpriced?
See, pricing is obviously a function of, it's like saying beauty lies in the eye of the beholder. So obviously it's a function of what time horizon. If you ask for next 2 weeks, 3 weeks, 4 weeks, people might be just wanting to do some trading gains. That's not the way we really approach it from a money management perspective. Every stock, whether it's an IPO or an existing listed stock, is evaluated across a time span, across a life cycle, and for its future cash flows. And that's how we attribute valuations to a particular stock. So there is, again, as I said, there is no one size fits all.
All right. I'm afraid we've run out of time on that note. But thank you so much, Lakshmi, for taking time out, for being with us here on Money9's Money Masterclass and helping us get some clarity on how to go about investing when it comes to NFOs and IPOs and stocks themselves. Thank you so much for being with us here on Money Masterclass.
Thanks.
For more videos like this, subscribe to our YouTube channel. You can also follow us across all social media platforms: Facebook, Twitter, Instagram, and LinkedIn. @Money9Live is our handle. You should log on to our website, www.money9.com, for all the latest from the world of personal finance. Thank you for watching. Keep it with Money9.